Today, we are diving into a really cool paper that sets up an epic showdown: modern AI versus classic statistical methods. The challenge? To see who can actually predict the stock market. So let's see who takes the crown.
I mean, that's the billion-dollar question, isn't it? It's one of the toughest nuts to crack in finance. For years, the best minds have been trying to build the perfect crystal ball for the market. But what if the entire way we're thinking about the problem is just wrong?
You know, when we look at the stock market, we tend to see one single line going up or down. But that's not the whole picture. That top line, the S&P 500, is really just the sum of all the different sectors underneath it. You've got tech, finance, healthcare, you name it. And each of those sectors, well, they're the sum of all their individual companies. So to predict that top line, you have to get everything underneath it right too.
And that is the real game changer here. It's not about making one single prediction. It's about building a whole pyramid of predictions. You need to forecast Apple, and you also need to forecast the entire tech sector, and you need to forecast the total S&P 500. And the kicker? They all have to add up perfectly. This makes the problem way harder, and it's got a name: hierarchical forecasting.
Okay, so let's break down what this pyramid of predictions actually looks like in practice. All right, so the fancy technical term for this is a hierarchical time series. But don't let the name fool you. The concept is pretty simple. It just means your data is organized in levels, kind of like a family tree. Individual stocks are the kids, the sectors are the parents, and the total market is the grandparent at the top.
So for this study, the researchers built a three-level pyramid. At the very bottom, they forecasted the market value for 70 of the biggest, most influential companies in the S&P 500. Then, one level up, those companies were bundled into 9 industry sectors. And finally, all those sector forecasts were added up to predict the total market value at the very top of the pyramid.
So we've got the challenge. Now we need the challengers. This is where the showdown really begins. Let's meet our contenders.
In one corner, you have the statistical classics, ARIMA and ETS. Think of them as the seasoned, established champions. They operate on very strict mathematical rules and are fantastic at spotting clear trends and patterns from the past. And in the other corner, you have the AI challengers, LSTM and GRU. These guys are the adaptable newcomers. They're a type of neural network that can actually learn and remember things over long periods. So instead of following fixed rules, they hunt for complex, hidden relationships in the data, which makes them perfect for the chaos of the market.
Okay, the stage is set. The contenders are ready. Let's get to the main event and see how this face-off actually went down.
The rules of the fight were pretty straightforward. Both teams got market data from 2021 to 2023. Their job? Forecast the market value 30 days out at all 3 levels of that pyramid. And here's the crucial part. The goal wasn't just accuracy, it was also consistency. The individual company forecasts had to perfectly add up to the sector forecasts, which had to perfectly add up to the total market forecast. The winner would be whoever had the lowest overall error.
Now, this idea of consistency has a name. It's called coherence, and it is absolutely everything. Like the researcher said, coherence ensures decisions across different levels are in sync. I mean, just imagine a big company where the local sales team is forecasting something totally different from the national team. It would be pure chaos, right? It's the exact same principle here. For these predictions to be useful, the whole pyramid has to hold together.
So, the fight is over. The numbers have been crunched. The big question is, who came out on top? Was it the classic champions or the AI newcomers?
Well, it was a knockout, a decisive victory for Team AI. The LSTM and GRU models consistently, and I mean consistently, outperformed the traditional models on every single level of that pyramid.
And honestly, it wasn't even close. The difference in the average forecast error is just striking. The AI challengers had a way lower error rate, which really proves they're so much better at capturing those super complex, hidden dynamics in financial data that the old school models just can't see.
So how much better are we talking? Get this, the best AI model, when paired with a best strategy, was up to 44% more accurate than its own starting forecast. That's a huge leap in precision, and it was all unlocked by making sure every prediction in that pyramid was perfectly coherent.
So what was this secret sauce, this knockout strategy? It was something called a middle-out approach. Basically, instead of starting at the very top or the very bottom of the pyramid, the AI started in the middle with the 9 industry sectors. From there, it could add them up to get the total market and break them down to get the individual companies. It turns out that middle ground was the sweet spot. the perfect balance of detail and big-picture trends.
Okay, this is all really cool, but what does it actually mean for us in the real world? Why does any of this matter beyond a paper in a journal?
Well, it's simple. Smarter forecasts lead to smarter money decisions. For investors, this could mean way more informed choices about where to put their money and a much better handle on risk. For financial planners, it could totally sharpen their strategies. And this doesn't just stop with the stock market. You could apply this same approach to crypto, to dynamic hedging. The possibilities are huge.
Now, of course, it's not all perfect. There's always a catch, right? While the AI models were way more accurate, they also took a lot more time and a lot more computer power to train. So it really highlights that trade-off between getting the most precise answer and the resources you have available. What's so powerful about this study is that it shows AI isn't just spitting out a single number. It's actually learning to understand the deep, complex, interconnected structure of the market itself. And that leaves us with a pretty wild thought to chew on. If AI is getting this good at explaining the market's past, what is it going to tell us about our future?